Hey everyone, it's time for another episode of Mayhem in the Markets, brought to you by Macrovisor, where we make macro actionable, and coming to you Sunday, May 21st. This is a real eye catcher. The Nasdaq's daily call volume was the highest level we'd seen since 2014 on Thursday of last week, leading us into that crescendo melt-up kind of rally that seemed to have petered out a bit on Friday or monthly options expiration. What makes this so noteworthy is that the NASDAQ composite is up about 21% year to date. People are calling it a new bull market. A lot of these gains are concentrated in just a handful of very large stocks. The breadth underneath the surface is not particularly impressive, but nevertheless, the top level rally in the NASDAQ itself is huge. And the fact that it's continued after the first quarter being one of the best first quarters for the NASDAQ ever is quite noteworthy. So seeing this call volume, this surge of optimism might be a bit of a sign that perhaps people are getting a little too excited here. Maybe there's some complacency or greed happening in the tech index. And we can also see an interesting pattern. Every Friday, Lotto Friday, except for last week, we saw a pretty enormous amount of mega cap tech volume in calls. AMD, Google, Tesla, Nvidia, Meta, Apple, and Amazon. And why is that important? Because that's that sort of Lotto Friday mentality that some of these are just plays that people want to get into because Fridays tend to be upbeat days. They tend to have, most of the time, obviously OPEX days are a little bit of an exception on a monthly and quarterly basis, but they tend to end higher, right? And so when you see this kind of concentrated call buying, that's really what a lot of these folks are looking for. They're looking for an easy play in the concentrated leadership of the market to lead Friday higher in these NASDAQ stocks. Speaking of NASDAQ stocks, we can see the lopsided rotation into tech, the Eurozone, equities in general as an asset class, industrials, bonds, and discretionaries, and a big push out of commodities, utilities, emerging markets, U.S. stocks, and materials. So this is what May has looked like so far based on fund manager positioning. And I think it's interesting. I do think that there's a little bit too much exposure to tech. And I think that we've seen banks, particularly regionals, have a lot of short interest. The KRE ETF at over 80% short interest has probably used as a hedging vehicle, if not anything else, but certainly interesting to see the lopsidedness of those trades. And we see those big inflows into tech as visualized here. This is such a it's a jaw-dropping amount of money coming in. The velocity too. Look at that. It's basically just a straight line up. You can see it's more velocity than what we saw in late 2022, and it's somewhat similar to what we saw in that March rally in early 2022. Nevertheless, those tech flows, if we're not looking at the 4-week, if we're just looking at the billions, this is the largest inflows we've seen since late 2021. So I think that does tell us that if all that money is just chasing a handful of these very large tech stocks, and obviously there's noteworthy exceptions in the small and mid caps, but for the most part, it's these large and mega caps that might be getting a bit crowded, that we might be getting just a little bit too excited about tech, particularly as it seems like we're still in a late cycle environment and likely a counter trend bear market rally. We can also see the visualization of long big tech and short U.S. banks being a rather crowded trade here, really the most crowded since April of 2020, July of 2016. Those are the two times it got this lopsided. I think this time is maybe there's more room for the trade to get more lopsided, but I think it's pretty darn lopsided if we look at the lack of positioning in financials and the immense positioning in tech. You can see in the chart below that institutions are net sellers of U.S. equities, index funds and ETFs are buyers, as are hedge funds starting really this year, and individuals are kind of flat to down. They've been lightening up, but not nearly as much as what we've seen from institutions. The relationship between the Russell 2000 and the NASDAQ is significantly stretched, with the NASDAQ coming back to the COVID lows versus the small cap index. And this is a sign that small caps are underperforming, led down by these regional banks, as large tech really leads the way. So this is just another one of those signs of just how stretched that relationship is between tech and regional banks, but also tech and smaller cap stocks as well. And it's another illustration of a lack of risk appetite in this market. We can also see that one relationship that had held true for much of 2022 and into early 2023 was the relationship between TLT and QQQ, or the 20-plus year bond ETF, and the NASDAQ 100. They are diverging rather meaningfully here. It might be one of the largest divergences I've seen. And either the relationship is breaking down, and it is a short-term relationship, or this is due for a pull one way or the other. The jaws, as I like to call them, are wide open here. And either TLT is going to lead QQQ down, QQQ is going to lead TLT up, or they're going to meet in the middle. But there is some room for these to try to correct back. Usually it's TLT that leads QQQ down. And the reason for that is you could kind of consider this a very simplified way of modeling for risk premium. And at this point, there's negative risk premium. So it would make sense with rates having moved higher that the NASDAQ should move lower. But that doesn't necessarily mean that's what's going to happen in this topsy-turvy upside down market. It just means it's one relationship to continue to watch here because it's been important as we've navigated throughout the bear market. We can also see M2 money stock is reverting to trend. This isn't necessarily a bad sign, but it is something that's worth keeping an eye on. And essentially what it's telling you is that we are seeing money supply drop. It's the first time since the 1930s that it has dropped, but it's not the end of the world. It doesn't necessarily portend to a depression or a recession in and of itself. But what it does tell us is that people are going to have a harder time paying back the interest on their debt, because interest on debt is money that does not exist in the money supply, and money supply is shrinking. It also gives banks a harder time lending into the economy. Both of those are constraints that may slow the economy further. We can also see that the leading economic indicators have made a 13th month in a row of negative readings since 1960. 6 months or more of negative readings have always led to a recession. Will this time be different? We will have to wait and see, but it is likely that these leading economic indicators pull real GDP lower, and we can see the pretty tight relationship between the two on this chart. We can also see that the debt ceiling looks more like a debt elevator. Up, up, and away it goes. There is no seemingly mitigating impact. The ceiling seems to be something that just keeps going higher. As they say, raise the roof. Well, they sure are. And that's telling us that maybe the debt ceiling is more problems than it's worth. It doesn't seem to be completing anything resembling helping for a higher degree of fiscal prudence or restraint. We can also see in 2023, there's been 236 bankruptcies so far. Some of these have been pretty large, so the number doesn't tell you the whole story, but it is the highest level we've seen since 2010 on the tail end of the great financial crisis. And I think it's very interesting how low the bankruptcies were last year. But nevertheless, I would also be paying attention to the size of bankruptcies so far year to date, because it is rather large. Retail sales last week were worse than expected. The expectation was 0.8. We got 0.4%. Discretionaries led the way after a very weak March, so they're basically evening out. But I would say what this is telling us is there isn't necessarily a resumption in consumer health. It's really more of a normalization, because if you look at where we were in Feb, March, and where we went to in April, we're not even back to even, really, other than discretionary. We're still in a 3-month trend lower. And we could see some signs of that. Bank of America posted their credit and debit card spending per household based on sectors for April and March. And we could see in this data that the consumer was weakening further, particularly in furniture, fashion, home improvement, and clothing, as well as in lodging and housing related services. General business conditions from the Empire State Index also rolled over materially. down below 30 when the expectation was, I believe, -3. This was a really bad reading. New orders led the way lower, as well as backlogs. This is just telling us that, at least in New York, there was not nearly as much demand for manufacturing. The Philadelphia Fed Manufacturing Index was a stark contrast, showing us a bit of the opposite. It wasn't that it was good, it was just less bad than expected. And we can see this for the Empire State: new orders, shipments, and backlog or unfilled orders all falling, all in contraction territory, and showing further deterioration from April. And then finally, the first rate cut has not always been received positively by the markets. And I think this is important because there's a lot of talk of, if the Fed pivots, all of a sudden the market's going to move higher. Not necessarily, and often is the case that a pivot is happening because there's something meaningfully wrong in the broader market. So we can see in 2001, 2007, and 2020, that pivot was not well received by the market. And it was in 1984 and in 1995, but 1989 was more of a flat line for a lot of volatility. So I would say, at the end of the day, there's no reason to suspect that the first Fed cut is what puts in a bottom. If we go back 100 years of monetary and market history, it's typically after 10 months from the first cut that we see a bottom, unless it's an outlier like COVID, where the Fed aggressively cuts all at the same time while also injecting an inordinate amount of liquidity into the system, and joined by other global central banks in doing the same. So why does that all matter? Context is important, velocity is important, and if the new cycle is started by what we've seen in the past, where it's, one rate cut, one meeting, another rate cut, another meeting, it might take a little while before the economy and earnings in the market trough. So I want to thank you all for tuning in. Really appreciate it. I also want to let you know you can check out MacroVisor right now with a 30% discount until the end of the month. This is our Memorial Day sale. You get 30% off for your first year, whether you sign up for our monthly plan or our yearly plan. That also gives you an additional discount for signing up for a year. You're basically going to get 2 months for free. So you can check out the link in the description text below. This is where we discuss a lot about the bigger picture, longer term themes and trends. We also have been giving these very in-depth earnings previews and reviews from the weeks that were, talking about what's coming up, what we're watching, and close coverage of the most important macro data and developments. So it's a great resource. It's something you can get now for 30% off for the next 12 months. So it's a really solid deal we're offering. Also, check out TraderAid.com, where you can learn more about short to intermediate term trading as driven by technicals and some over the top macro factors, these sort of top down drivers that we see. And you can get 20% off your plan on me at TraderAid using the code Mayhem20. You also can get your first 10 days free as a part of our free trial on our base plan. And follow me on Twitter at Mayhem for Markets. That's at Mayhem #4 Markets. And be sure to like, subscribe, and share this post with others if you enjoyed it. Thanks again for tuning in, everyone, and I'll look forward to catching up with you soon with more content on this YouTube.